Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Exxon Mobil.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we dive into today's analysis, just a quick note. Here is a useful chart tool for investors and traders. If you want help reading trading charts more clearly, you can check out VIP Algos through the link below in the description.
Right.
VIP Algos is a TradingView indicator suite, and it shows visual buy and sell chart alerts, trend direction tools, support and resistance zones, and take profit and stop loss planning areas.
Yeah, super helpful visual stuff.
Exactly. It can be used across markets like stocks, forex, crypto, gold, indices, futures, and more. But just remember, VIP Algos is an educational chart analysis tool only.
Very important.
Right. It is not financial advice, it does not place trades for you, and it absolutely does not guarantee profits. Trading involves risk, so always manage your risk and, do your own research. This is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
Perfect. So let's get into this because I want you to imagine a company that actually makes more money on a major segment of its business when the price of its core product just plummets.
It sounds completely backwards.
Right. It sounds counterintuitive, like almost impossible. But as we watch the Iran ceasefire completely collapse today, we're looking at an energy titan that does exactly that.
Yeah.
While, simultaneously surfing this massive new geopolitical wave, ExxonMobil is literally dominating the financial conversation right now.
Oh, for sure. It's everywhere.
The stock is currently trading around $138.88,
Yeah.
which, that is down about 21% from its 52-week highs.
Right.
But suddenly we get these reports of U.S. strikes on over 80 targets, and it's just sent global oil prices surging. So we had this legacy energy player that was, kind of cooling off, and now it's front and center on every market dashboard you look at.
Yeah, and that collision of a macroeconomic shock and market positioning, that's
Right.
where opportunity usually hides, right? You have this stock that has been systematically pulling back. It's just been taking a breather. But then an external event strikes that directly and immediately inflates the price of its primary commodity.
The ultimate catalyst.
Right. So right now, the entire market is basically scrambling to reprice Exxon in real time to account for this entirely new geopolitical reality.
But see, that real-time repricing is great if you're a momentum trader. But if you are a listener out there, a long-term investor building out a portfolio, you really have to ask how a traditional oil giant fits into a modern wealth-building strategy.
Definitely.
Like, are we just chasing a flashy headline here, or is there an actual foundational, structural reason to anchor your capital in this company right now?
Well, it serves as a premier defensive income-generating cornerstone.
Okay, defensive.
Yeah, when you're building a portfolio, you need certain assets that act as shock absorbers, Companies that provide stability and just spit out cash regardless of the broader economic weather.
Rain or shine, basically.
Yeah, exactly. And Exxon fits that profile perfectly. The root of that resilience really comes down to the absolute elite quality of their resource base.
Okay, let's unpack that phrase real quick, resource-based quality. Because, look, if you just drive a car, oil is oil, right?
Sure.
It's a global commodity. It all goes into the same barrel, and it sells for the exact same global market price. So why does Exxon's specific oil matter more than anyone else's?
Well, to the consumer at the pump, it doesn't matter at all. But to the producer, the underlying cost of pulling that specific barrel of oil out of the ground changes the entire financial equation.
Ah, okay, the extraction costs.
Right. A perfect example is Exxon's stake in the Guyana Stabroek block.
Guyana.
Yeah, it's an offshore deep water project, and it has absolutely become the crown jewel of their portfolio. The estimated breaking cost to pull a barrel of oil out of that specific block is between $25 and $35.
Okay, wait. If global oil prices are hovering around, say, 70 or 80 bucks right now, and their break even is 25 to 35, the margin of safety there is just enormous.
It's staggering. The underlying geology and the massive scale of their offshore floating production vessels, it just allows for incredible efficiency.
Yeah.
It literally means that if we hit a severe global recession tomorrow and oil prices plummet to $50 a barrel, which, by the way, is a threshold where many smaller independent shale operators start bleeding cash.
Oh, yeah, they start laying off workers facing bankruptcy.
Exactly. But Exxon, they are still comfortably printing billions in free cash flow just from those Guyana assets alone.
See, I have to push back on that resilience a little bit, though.
Okay, go for it.
What happens when oil goes through its inevitable, brutal, cyclical bust? Because it always does, right?
It does.
The old saying goes that the cure for high oil prices is high oil prices. Demand eventually drops, supply floods the market, and suddenly the bottom just falls out of the commodity. How does this so-called wealth-building cornerstone survive a structural bust without slashing its value and cutting its dividends?
And you are hitting on the exact reason Exxon isn't just a drilling company. The defense against that cyclical bust is their vertically integrated moat.
Vertically integrated, meaning they do everything.
Exactly. Exxon handles the entire life cycle of the molecule. They drill for it, that's the upstream side. But they also own the midstream logistics, the pipelines.
Right.
And they operate massively complex downstream businesses like global refineries and chemical plants.
So they literally control the product from the rock all the way to the plastic in your phone.
Precisely. And that vertical integration creates a natural internal hedge. When crude oil prices crash, it absolutely hurts their upstream drilling revenues.
Makes sense.
However, cheaper crude oil acts as a much cheaper raw material for their downstream refineries. The difference between what they pay for the crude and what they sell the refined gasoline or jet fuel for is called the crack spread.
The crack spread, okay.
Yeah. Historically, when crude prices fall, those refining margins actually expand.
Oh, wow. So they make up the difference on the other end.
Exactly. That internal balancing act is the fundamental mechanism that has allowed them to increase their dividend for over 40 consecutive years.
40 years.
Yeah, through wars, recessions, global pandemics.
That is wild. But look, if you're holding this stock and looking at the current balance sheet, there is a headline metric that might make you panic a bit.
Let me guess, the revenue.
Yeah. Trailing 12-month revenue is currently down 4.09%.
Right.
For a company of this sheer size, seeing the top-line contract feels like a glaring red flag. Is the actual core business shrinking?
So we have to separate cyclical compression from a structural decline.
Okay.
The revenue contraction you are seeing on the screen is purely a reflection of commodity prices cooling off from the absolute supercycle peak we saw in 2022 and 2023.
When everything was just historically expensive.
Exactly. Exxon isn't pumping less product. They aren't losing market share to competitors. The physical volume of business is incredibly healthy. It's simply that the product they are selling isn't fetching the extraordinary inflation-driven premiums it was 2 years ago.
Okay, so if the top line is inherently tied to the commodity cycle, how is their actual operational profitability holding up underneath that revenue drop?
Honestly, their cost discipline is really shining through right now. Despite the top-line dip, their gross margin is sitting at a massive 28.74%.
Almost 30% gross margin on oil.
Yeah, and the net margin is holding incredibly strong at 7.76%. That translates into an earnings per share, or EPS, of $5.93.
Which, I mean, is obviously down from those crazy 2022 peaks.
True, but the context is what matters here. You have to compare that $5.93 to their pre-COVID baseline.
What was it back then?
In 2019, their EPS was around $3.24.
Oh, wow.
So even with revenue pulling back from the recent peak, their earnings floor has been permanently reset at a much higher level. They used the pandemic crisis to restructure, they cut massive organizational inefficiencies, and they are simply a much leaner, vastly more profitable machine today than they were 5 years ago.
Right, so they basically used the crisis to get fit.
Exactly.
And it's a 7.76% net margin on hundreds of billions in global revenue equals a staggering amount of free cash flow.
So where is all that cash actually going? Because they aren't just stuffing it under a mattress, right?
Not at all. They are deploying it very aggressively into shareholder returns and high-efficiency growth.
Yeah.
First off, they have a massive $20 billion annual share repurchase program authorized all the way through 2026.
Okay, so $20 billion a year. And by buying back their own stock, they are reducing the total supply of shares on the open market, which artificially concentrates the earnings and naturally boosts the value of every share left in your portfolio. Precisely. And beyond the buybacks, they are currently digesting their massive acquisition of Pioneer Natural Resources.
Oh, I heard about that one.
Yeah, and this wasn't just about getting bigger, it was about geometry and efficiency. By acquiring Pioneer, they secured highly contiguous acreage in the Permian Basin.
Meaning all the land touches.
Right. So instead of drilling a 1-mile horizontal well, hitting a property line, and having to expensively move the rig, they can now drill massive 3-mile-long horizontal laterals because they own all the adjacent land.
That makes total sense. It's an operational synergy, not just buying revenue to look good.
Exactly. It slashes the cost per barrel dramatically.
I also saw they announced a brand new $1 billion commitment to launch the Usan infill project in Nigeria.
Yeah.
What does an infill project actually mean? It sounds like they're just patching holes or something.
It's actually one of the lowest risk, highest return ways to deploy capital. An infill project basically means drilling new wells between existing ones in a field they have already established.
Oh, so the infrastructure is already there.
Exactly. The expensive floating infrastructure and pipelines are already sitting there. They are just extracting bypassed pockets of oil. For that $1 billion capital outlay, they expect to add 40,000 barrels per day of highly profitable production.
40,000 barrels a day. That's huge. And looking at their debt profile, the balance sheet looks virtually bulletproof right now.
Very much so.
I mean, they're trading at a 2.25 price-to-book ratio. That means you are only paying a little over double the literal liquidation value of their massive global assets, which just adds to that defensive floor we discussed earlier.
Yep.
Plus, their net debt to capital is well below their own 20 to 30% target range. They've aggressively used the good times to pay off the credit cards, basically.
They are entering this current wave of geopolitical uncertainty from a position of absolute financial fortress strength. It's impressive.
But, a strong balance sheet alone doesn't magically force a stock to move upward tomorrow. We need to look at the catalyst timeline. What specific scheduled or unscheduled events will actually drive this stock higher in the near term?
Well, the most immediate and explosive catalyst is the geopolitical tailwind unfolding right now.
Right, Iran.
The declared death of the Iran ceasefire and the subsequent strikes on over 80 targets immediately injects a massive risk premium into global oil markets.
Because the market suddenly fears a physical supply disruption.
Exactly.
If things escalate and, say, the Strait of Hormuz is threatened, millions of barrels of daily supply could be choked off, creating this bidding war for whatever oil is left.
And for Exxon, every single dollar that the price of global crude goes up flows almost entirely to their bottom line on the upstream side. It acts as a massive immediate catalyst for revenue, completely independent of anything management does.
Geopolitics is definitely the wild card. But what about the actual calendar? What scheduled events are institutional investors watching right now?
The primary focus is their Q2 2026 earnings, which will drop in late July, early August.
Okay.
Because of this recent geopolitical spike in oil prices, there's a very strong probability that the current consensus EPS estimates on Wall Street are just too low.
Interesting.
If the realized price for crude averaged above $80 a barrel during the quarter, we could see a significant earnings beat that forces analysts to upgrade their models.
And after earnings, I assume the market shifts its focus back to the macro environment, right?
Yeah, definitely.
We have the crucial August OPEC Plus production decision coming up. Will they extend their voluntary cuts or adjust quotas to flood the market? Any tightening of supply there obviously further supports Exxon's realized prices.
Exactly.
But looking slightly further out, you have the September 2026 Federal Reserve rate decision. If the Fed finally cuts interest rates, that typically weakens the U.S. dollar.
Yes, it does.
Since oil is priced globally in dollars, I have to assume a weaker dollar automatically boosts commodity prices because it takes more dollars to buy the same barrel, right?
You've outlined the exact macroeconomic mechanism perfectly. A rate cut acts as a natural underlying boosting catalyst for commodity prices, which directly benefits Exxon's international revenue translation.
Okay, let me throw an analogy at you because this is where investors get tripped up all the time.
Go for it.
If I turn on the news and see a massive Category 5 hurricane heading for the coast and I rush to the store to buy an umbrella, they're probably already sold out or the price has been marked up 300%.
True.
The event is public knowledge. So if we were debating whether this war premium is already priced in, aren't we just buying expensive umbrellas here? Has the market already accounted for all of this geopolitical risk?
Well, to figure out if we are too late to the party, the only way to find out is to look at how buyers and sellers are actually behaving on the chart right now.
Okay, so if we look at the technicals and the price structure, what story is the chart telling us?
The technical landscape is incredibly compelling for this setup. The stock is currently stabilizing in what technical analysts call a higher-low consolidation pattern.
Higher low.
And it recently pulled back to a classic Fibonacci 38.2% retracement level.
All right, for those who don't spend their days staring at candlestick charts, a 38.2% retracement basically means the stock took a massive run-up and has now gracefully given back about a third of that move. It's just taking a breather and finding a new floor, right?
Exactly, yeah. It's considered a very healthy structural correction within an overarching long-term bull trend.
Got it.
If we look at the specific time frames, the 13-week return is negative 16.14%. That represents the pullback, the correction phase from the recent local highs.
Right.
But if you zoom out to the broader 52-week return, it remains a very solid positive 20.79%. The long-term trajectory is still decisively pointing up.
And looking at the momentum metrics, it really seems like the selling pressure is simply exhausting itself. The 10-day volume is contracted significantly. It's trading at about 0.82 times its normal volume regime.
Yes.
And alongside that lower volume, the 5-day return has flattened out at a very slight positive 0.27%.
Which brings up a vital point about market psychology and supply mechanics. When a stock pulls back and then the trading volume suddenly dries up while the price simultaneously stops falling, it tells us the aggressive sellers have simply run out of shares to dump.
Okay.
The supply of motivated sellers is completely exhausted.
The selling volume drying up acts like a pressure valve that's been tightly shut. The energy is just trapped there.
Yeah.
Now, I do see the trailing 12-month PE ratio is sitting at 22.59. That means investors are willing to pay almost $23 for every $1 of Exxon's earnings. That is definitely near the upper end of its historical range. But, given that volume contraction and the geopolitical setup, it looks like that tightly shut valve is just waiting for an earnings beat or a geopolitical trigger to blow the lid off.
The price structure strongly suggests the market was taking profits after a long run, but it has now established a firm base, actively waiting for the next directional cue to resume the upward trend.
So what does the professional market sentiment look like? The chart shows the retail and institutional selling is drying up. But how are Wall Street analysts actually feeling about the company's valuation here?
The aggregate sentiment across the street is cautiously bullish. You definitely have some analysts maintaining hold or neutral ratings as they wait for clarity.
Sure, playing it safe.
Right. But what's fascinating is where the top-tier firms are setting their actual price targets. They are implying massive upside potential from current levels.
Give me the hard numbers. What are they projecting?
So RBC Capital recently reiterated their target of $180. From where we are today at around $139, that implies a massive 32% upside.
32%, wow.
Yeah, and Mizuho lowered their target slightly to $170, but that still implies a 22% upside. Furthermore, if you look beyond just Exxon to the broader energy sector, macroeconomic sentiment indicators are nearing a long-term buy signal, suggesting a cyclical bottom for the entire energy space might be imminent.
But there is a very curious, almost contradictory data point we need to discuss here.
Oh.
What's that? If we look at insider buying, meaning the executives, the CEO, or board members actually purchasing shares on the open market with their own personal money over the last 90 days, the number of buys is exactly zero.
Right.
No buys, no sells. If the stock genuinely has 30% upside, why isn't management aggressively backing up the truck? Are they just waiting on the sidelines to see how this geopolitical dust settles?
It's a very fair observation and one that investors should always check. However, the absence of insider buying isn't inherently a bearish signal, especially since there is absolutely zero insider selling either.
Okay, that's true. Nobody is bailing out.
Exactly. It primarily suggests a level of macro caution. Management has perfect visibility into their own refineries and drill sites, but they do not have perfect visibility into the minds of leaders in the Middle East.
Very true.
They might simply be waiting for the geopolitical environment to gain some stability before deploying millions of their own personal capital.
We've laid out the bullish case pretty well here, but with Wall Street floating 32% upside targets, we have to flip the coin and demand to know the downside. What is the bear case? What specific events could utterly destroy this bullish thesis?
Well, the single biggest immediate risk to this trade is rapid geopolitical de-escalation.
Which is obviously a fantastic thing for global peace, but a potentially devastating thing for short-term oil prices.
Exactly. The current bullish momentum relies heavily on the Iran conflict sustaining these elevated risk premiums in the commodity markets.
Right.
If diplomats were to miraculously negotiate a return to the ceasefire tomorrow, that risk premium vanishes overnight. We could see crude oil rapidly retreat back to the $65 to $70 range as supply fears just evaporate.
And as we saw with that 13-week return of negative 16%, when oil drops, Exxon's stock can sell off incredibly fast as the algorithms dump energy exposure. Their upstream margins would compress significantly.
That is the primary commodity risk for sure. But there is also a major political and regulatory risk looming over the entire sector. Major media outlets are already starting to utilize phrases like Iran war windfall.
Because if oil spikes entirely due to overseas conflict, the oil companies accidentally make billions in extra profit without actually innovating or doing anything different.
Yes, and that dynamic puts big oil on a severe collision course with political figures, regardless of the party in power. We saw this historically in 1980 with the Crude Oil Windfall Profit Tax Act, and more recently with the energy profits levies across Europe in 2022.
Oh, right.
When the public is feeling the excruciating pain of high inflation at the gas pump, and corporations are simultaneously posting record, conflict-driven profits, it invites immense populist scrutiny.
It becomes an irresistible political target. I mean, from a pure market analysis perspective, high visibility profits during periods of intense inflation can easily trigger talk of new windfall profit taxes, export limits, or severe regulatory crackdowns that would eat directly into those 7.6% net margins.
Absolutely. It's the ever-present risk of political retaliation against their profitability. Finally, there's the risk of market misinterpretation.
How so?
Well, we discussed how that 4.09% top-line revenue contraction is mostly a cyclical hangover from 2022. But the broader market isn't always perfectly rational or patient.
Algorithmic trading bots just read a headline that the top line is shrinking and immediately hit the sell button.
Exactly. If the broader market mistakenly extrapolates that temporary cyclical dip as a structural permanent decline in the core business, they could punish the stock unfairly, completely ignoring the underlying cash flow strength and those massive share buybacks.
So with all the cards on the table, what is the final verdict? We have incredibly low breaking costs in Guyana and a bulletproof balance sheet on one side of the scale. On the other side, we have severe windfall tax possibilities and de-escalation risks. How does this score out?
Evaluating the totality of the data, the fundamental strength, and the technical setup, the final rating is a bullish score of 7 out of 10.
7 out of 10, okay.
The ultimate stance is that Exxon offers a highly attractive, asymmetric, risk-to-reward profile at this $139 level. The downside floor is fiercely protected by their ruthless cost discipline, while the upside ceiling is being actively lifted by global events.
But how does that strategy break down across different investing timeframes? Because, a day trader trying to catch momentum and a retiree building income are playing two completely different games.
Great question. In the short term, looking at the next 4 to 6 weeks, this sets up as a very solid swing trade into Q2 earnings, riding the immediate momentum of this geopolitical oil spike and the tightly coiled technical chart.
Okay, so that's the short game.
Right. If you are looking medium term, say 3 to 6 months, you hold for that broader energy sector sentiment buy signal to officially trigger and to see how the crucial August OPEC Plus supply decisions play out.
And for the long-term wealth builders who want to hold this for years.
For a 12-month plus horizon, this is a core defensive portfolio position. Your patience is inherently funded by their dividend, fueled by the highly efficient production growth in the Permian and Guyana, and permanently supported by that relentless $20 billion buyback program, reducing the share float day after day.
All right. I want to explicitly remind everyone listening that this talk is entirely an educational analysis. This is not financial advice, and we are not telling you to buy, sell, or hold this or any other security. You always have to do your own independent research before risking capital.
Absolutely.
And if you're looking for a cleaner, more visual way to read trading charts while conducting that research, check out VIP Algos through the link below in the description. VIP Algos is a TradingView indicator suite featuring visual buy and sell alerts, trend direction tools, support and resistance zones, and TPSL planning areas.
Yeah, it's a great tool.
It can help make complex charts easier to scan and understand, but remember, it is still only an educational chart analysis tool. It is not financial advice, it does not place trades for you, and it does not guarantee results. Trading involves real risk, so always do your own research and manage your downside risk. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this analysis helped you better understand the markets today, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua Talk.
As you close out your charts and look at your portfolio today, just think about this profound irony. We spend so much time in the financial world talking about the rapid, inevitable transition to renewable energy and the death of fossil fuels. Yet the absolute real geopolitical tension flares up. The entire global market immediately defaults to desperately repricing traditional oil. It makes you wonder, is the market's reliance on these legacy energy titans actually fading away, or are they just waiting in the wings for the next crisis to prove they are still the indispensable bedrock of the global economy? Something to mull over. Catch you next time.